Picture this. It's 1985 in a gritty factory town outside Detroit, Michigan. My Uncle Mike, a blue-collar hero straight out of a Springsteen song, clocks 12-hour shifts at the auto parts plant, assembling wiring harnesses for Ford trucks. By dawn, he's out mowing lawns in the suburbs of Dearborn, sweat-drenched and determined to keep food on the table for my aunt, my cousins, and my single mom after my dad bailed. Any spare cash? He stuffs it into an old work boot under his bed or a savings account at the local credit union, earning 0.5% interest, if that. His dream? Retire early, buy a cabin up north in Michigan's Upper Peninsula, fish Lake Superior till sunset. Then Uncle Mike dips a toe into the stock market with $5,000 from a bonus. My grandpa, a lifelong GM retiree, calls it gambling with the rent money. But here's the twist Grandpa missed. He was the real gambler. Every year, his cash stash lost 4 to 5% to inflation, the silent thief eroding purchasing power as the Fed printed more dollars. By 2010, that boot money bought half the groceries it once did. Uncle Mike? His stocks compounded, turning that $5,000 into over $50,000 by retirement, funding that cabin and grandkid college funds. That story hit me hard as a kid in the Rust Belt. Inflation doesn't just nibble, it devours dreams. Today, with my portfolio growing $20,000 plus weekly through smart, hands-off strategies, I've built generational wealth. I'm no suit on CNBC. I'm a regular guy who's lived it. This video is your roadmap, the playbook I wish a 16-year-old me had in Pontiac MI. We'll crack the code. How do you beat inflation, build millions, and sleep easy? Stick around. Your future self will thank you. Beating the inflation monster, the first puzzle piece. Inflation is America's hidden tax, averaging 3.7% annually since the 1960s, per BLS data. Your $100 today, worth $96.30 next year, $92.80 the year after. Savings accounts? Laughable. National average APY is 0.45%, FDIC stats. You're bleeding wealth daily. Stocks flip the script. Owning a share makes you a part owner in powerhouse companies like Apple, Microsoft, or Coca-Cola. Profits come two ways. Price appreciation, buy low, say Amazon at $100 per share in 2010, sell high, $3,500 plus today. Dividends, quarterly cash payouts from profits. Procter & Gamble sends checks like clockwork. Even if you hold forever, money flows in. The real magic? Compounding, like a snowball rolling downhill, gaining size with every turn. Albert Einstein called it the eighth wonder of the world. Let's crunch numbers with a free calculator like Investor.gov's tool. Scenario: you invest $300 per month, post-tax from a $50,000 job, at 8% average annual return, S&P 500 historical norm, minus fees. After 20 years, approximately $165,000. 30 years, approximately $500,000. 40 years, approximately $1.4 million. Bump to $500 per month, hits $2.3 million in 40 years. Not pie in the sky. This mirrors Vanguard's long-term data. Warren Buffett beat pros by betting on America via index funds. Start at 25. You're a millionaire by 65. Start at 45. Half that. Time is your superpower. When to jump in. Timing the starting gun. ASAP. Yesterday was better. A 25-year-old investing $200 per month at 7% nets $1 million by 65. Wait till 35? Same effort yields $400,000. Why? Compounding needs decades. Real-life hurdle? Life. Student loans from state schools, $30,000 average. Car payments on a used Chevy, rent in Atlanta or Phoenix. Here's your battle plan. Step 1. Nuke high-interest debt. Credit cards average 21% APR, Fed Reserve. Paying that off is a 21% risk-free return. Example, $5,000 balance at 20%, costs $1,000 per year in interest. Stocks might return 10%, but you're net negative. Pay minimums on low-rate stuff. Mortgage at 4%, smash cards first. Step 2. Emergency Fund Fortress. 3 to 6 months expenses in a high-yield savings, Ally or Capital One at 4.5% plus. Job loss, car breakdown, no forced stock sales at Lowe's. My buddy in Chicago lost his warehouse gig in 2008. Emergency funds saved him from panic selling at the bottom. Step 3. Green light. Debt gone, cushion built, invest. Under 18, custodial brokerage, Fidelity or Schwab, via parents. It's legal, tax smart, and launches you ahead. Teens. Paper trade on Thinkorswim, TD Ameritrade, with fake cash. Builds instincts, zero risk. How much to invest? The 70-20-10 blueprint. Wall Street wolves say, max it out. Nah, I've raced dirt tracks in Ohio, flown Cessnas over the Grand Canyon, tailgated Packers games. Life's not a spreadsheet. Balance fuels joy. 70-20-10 rule. My tweak on proven budgeting. 70% needs. Rent, groceries, gas. U.S. average $250 per month fill-up. 20% growth. Investments, debt paydown. 10%. Wants, NFL tickets, road trip to Yellowstone. Studies, like Vanguard's investor behavior research, show this crew outperforms savers, better weathering recessions, compounding ahead. On $60,000 salary, $1,000 per month to invest. Feasible post-basics. Scale up as income grows, side hustle, DoorDash or Etsy, funnel 50% to stocks. Buying your first stock, apps, accounts, and action. Apps democratize this. Robinhood, fractional shares, no fees. Fidelity, rock solid. Vanguard, low-cost king. Links below. Priority, tax-advantaged accounts. Skip taxable brokerages first. U.S. power plays. Roth IRA. Post-tax dollars grow tax-free. 2026 limit, $7,000. $8,000 if 50 plus. Withdraw anytime after 59.5 tax-free. Ideal for young hustlers. Traditional IRA. Pre-tax contributions. Tax on withdrawal. Good if high bracket now. 401k. Employer match equals free money. For example, 50% up to 6% salary. Maximum $23,500 in 2026. HSA. If high deductible health plan. Triple tax-free for medical. No Roth? Start taxable, roll later. Fractional shares mean $5 by 0.001. Apple shares, no full share barrier. Pro tip, auto invest. Fidelity's recurring investments pulls $100 per week seamlessly. Demo broker spotlight, Fidelity. Free to join, zero commissions, fractional everything. Practice mode simulates markets. Their pies, like M1 Finance, auto allocates, pick a Buffett-style pie, 90% S&P, 10% bonds, invest $100, it splits perfectly. New users, often free stock via promo, check site. UK/EU folks, trading 212 equivalent stateside. Picking winners, skip the casino, solve fundamentals. Day traders chase charts, candlesticks, RSI, head and shoulders. Fun for Vegas, suicide for wealth. 90% lose money. SEC data. Long-term, fundamentals. Ask, moat, unbreakable edge, Coke's brand, Visa's network. Leadership, CEO track record, Satya Nadella revived Microsoft. Financials, revenue growth, debt low, Yahoo Finance free. Valuation, P/E under 25, Guru Focus Screener. My method, buy and hold 3 to 5 years. Dip buy on charts, 50-day moving average. But 80% of my money? Not stocks. Index funds, pros beat 'em. Index funds, beating Wall Street pros with one click. Think NFL standings, top 500 teams, companies. S&P 500, Apple, iPhones fund innovation, Nvidia, AI boom, Walmart, everyday backbone. Losers drop out, Enron-style flops. Index fund, own the whole league cheap. One ETF, instant diversification. S&P historical, 10.7% annualized since 1957. NYU data. Last 10 years, 13.2%. Actively managed funds lag 1 to 2% yearly after 1% fees. SPIVA report. Index, passive, 0.03% fees. No 20-year S&P holder ever lost money. Market timing fallacy debunked. Top 3 index funds for Americans. S&P 500 trackers. VFIAX, Vanguard Mutual Fund, or VOO, ETF, 0.04% fee. Tech heavy, Magnificent 7, 30%, but America's future. $10,000 at 10% compounds to $174,000 in 30 years. Why? 11 sectors. Auto rebalances. My core holding turned $20,000 seed into $500,000 plus. Total stock market, broad U.S. exposure. VTSAX or VTI, everything, 3,500 plus stocks. 12.5% 10-year return, small/mid caps, juice upside, think next Tesla. Crashes, .com, minus 49%, 2008, minus 57%, COVID, minus 34%. All recovered. I've ridden all three. Patience pays. Emerging markets, global kicker. VWO, Vanguard ETF. China, BYDEVS. India, Tata, Brazil. Riskier, volatility 20% plus, but growth potential. India GDP up 7% per year, 5 to 10% allocation. Shenzhen Parallel, $50,000 condo in 2005, $1 million plus now. US misses this without it. Mix, 60% S&P, 30% total market, 10% emerging, rebalance yearly. Dollar cost average, invest fixed dollars weekly, buy more low. Advanced twists, ETFs versus funds, sector bets. ETFs trade like stocks, intraday. Mutual funds end of day, fractions. ETFs win for newbies. Vanguard's ITOT, total market ETF, or SCHB, Schwab. Themed VGT, Tech, XLE, energy for oil boom. But cap at 10%, don't chase. Bonds for ballast, BND, total bond ETF, 20 seconds/30 seconds, 90/10 stocks/bonds, 50 seconds, 60/40, crashes hurt less. Is this risky? Debunking the fear factor. Risk equals permanent loss. Inflation, guaranteed loss. Stocks, volatile short term, 2022 minus 18%, but up 100 times since 1980. Diversified portfolio weathers storms. 1929 crash, minus 86%, recovered by 1954. 1970s, stagflation, flat decade, then boom. 1990 bear, minus 90%, 1993, plus 94%. Young, risk up, time heals. My 2008 story, dropped 50%, held, tripled by 2013. Protectors, dollar cost averaging, 5 to 10% bonds. No leverage, margin equals margin calls. Biggest risk, inaction. Average American net worth, $192,000 at 45, Fed survey. Investors, double. When to sell, the exit strategy mystery, rarely. Young, hold till retirement. Sell signals, emergency, tap fund first. Dude stock, underperforms peers 2 years, cut, for example, sell Peloton post-COVID hype. Goal, hit, down payment, set target, for example, sell if plus 50%. Panic, no, annual check, up 10%. Smile, down, buy more. Retirement, 4% rule, withdraw 4% yearly, adjust inflation. $1 million portfolio equals $40,000 per year safe. Real American success stories, proof in the pudding. Rosie the Riveter, 2.0, Detroit nurse, $40,000 salary. Roth IRA, $300 per month since 1995, now $1.2 million, retired Florida Keys. Texas truck driver, 401k, max plus match. $800,000 at 55, early out, Silicon Valley. Starter, $100 per month, VOO in 2010. $250,000 today, you're next. Pitfalls to dodge, rookie mistakes. Timing market, miss best 10 days? Have returns, JP Morgan. Fees, 1% eats 28% of gains over 30 years. Emotions, FOMO buys high, fear sells low. Overtrading, taxes plus commissions kill. Fix, index, automate, ignore headlines. Scaling up from $100 to $1 million plus. Level 1, $0 to $10,000, Roth VOO fractions. Level 2, $10,000 plus, 401k max total market. Level 3, $50,000 plus, Tilt Emerging Individual Blue Chips, KOJNJ. Track Personal Capital App Free Net Worth. 2026. Outlook Why Now? AI Boom. NVDA up 200% YTD. Rate cuts, election cycle rallies. But don't predict. Participate. Call to action. Open Fidelity/Robinhood today. $50 in VOO. Compound starts now. Subscribe for stock picks, crash survival guides. Next, my top 5 blue chips for 2026. Hit like. Help the algorithm solve wealth mysteries for more Americans. Your millions await. Go build.